Welcome to the September edition of the Kluge Wealth Advisory Group monthly update video. In this month's video, we're going to touch on a number of segments, including back to the basics, a monthly market review, a monthly portfolio review, as well as answers to your frequently asked questions. And you'll also note in the email that accompanied this video that there are time markers, so that you'll be able to fast forward to the parts of this video that interest you the most if you so choose. And of course, if you have any questions or there's anything on your mind you'd like to discuss, please pick up the phone, give us a call, we're here to help. In this month's edition of Back to the Basics, we're going to touch on the basics of investment taxation. Now, for the purposes of this brief discussion, we're going to ignore the proposed capital gains legislation and assume that we are not talking about a RIF, RRSP, or TFSA account. We are talking about a cash account or a margin account. So it's very important to realize that not all investment returns are created equal. And there's three ways to earn investment return. There's interest, dividends, and capital gains. Now, all three of those are treated differently. The highest rate of taxation accrues to interest income and foreign dividends. And then Canadian dividends come up the middle, with capital gains being the most tax efficient. So in a real life example here, if you have an individual who's in a 48% tax bracket and earns $100 of return, if they do so from interest income, they would pay $48 in tax. If they did it from a capital gain, they'd pay $24 in tax. So you can see that's a significant difference. And that can have a big difference both on your annual tax bill as well as the rate at which your portfolio can compound. Now, we never want to make investment decisions for tax reasons, but it is something we do want to keep in mind. Which does lead to another strategy that we employ here at the Kluge Wealth Advisory Group, which is called asset location. And the basic idea behind asset location is that where possible, we want to locate those assets that attract the highest rate of tax inside of tax-deferred accounts like TFSAs or RRSPs. And we want to have the more tax-efficient investments, returns, happen outside of those accounts, capital gains. So this is something we want to keep in mind and something we do on a regular basis for clients. And that's the driver of it. It's a very basic difference between the taxation of interest, dividends, and capital gains. If you have any questions on this about how it might pertain to your particular situation, please give us a shout or email us, get in touch with us any way you'd like. Thank you. The month of September was very interesting from a market perspective, and there's lots to touch on in terms of equity, fixed income, and commodities markets. So let's jump right into it. At the biggest picture possible level, the month of September started out with a short, sharp correction and ended at new all-time highs. Now, this is a little unusual for September. However, we're going to take the win where we can get one. If we drill down a bit more, we see that in the United States, there was generally good sector performance. Most stocks were participating, and stocks were led by NASDAQ versus S&P 500, which indicates that growth stocks were outperforming again. In Canada, there was also tailwinds from financials, utilities, as well as base metal stocks and gold stocks. Now, as we came into month end in Canada, we were definitely positively impacted by the giant Chinese government stimulus plan that was announced. There was truly extraordinary performance from base metals miners and similar stocks, in addition to good performance from, as I indicated, from financials and from utility stocks. In terms of fixed income, September was another good month. We saw good returns from key fixed income indices, and you can see that in the performance of the XBB ETF, which is a broad Canadian basket of fixed income, and the AGG ETF, which is a broad US basket of fixed income. Now, as you may have guessed, in a broad sense, commodities did well in the month, despite the fact that oil is down. Now, that is because of very, very good performance from base metals and gold. From a portfolio perspective, there's not a lot to report for the month of September. We didn't make any major portfolio changes, and we remain in a risk-on market environment, which I expect to persist for the next few quarters. And this is on the back of falling interest rates, declining inflation, and positive but slowing economic growth. This combination has historically been very good for equities as well as risk assets of all types, and I do expect that this trend to continue over the next few quarters. Now, there's some other specific market commentary that I'll get into in the frequently asked questions, so I'll leave this commentary off here. One of the most frequent questions I encountered in my conversations over the course of September was, what happened? There was a bit of a bump there, but what was going on? Well, as a quick recap, there was a very short, very sharp market pullback that occurred in early September. And although it's very difficult to put your finger on exactly the cause of that pullback, it's very likely a combination of factors, including Mideast tensions, recession worries, worries around the economic implications of AI, and other factors. Now, it's important to note that over the course of September, after that pullback, the market rallied to new highs, where we stand at the end of the month. So I think when we look back at the big picture, there's not a lot that's changed. First of all, the macroeconomic picture looks the same as it has for months. We have falling inflation, falling interest rates, and positive but moderating economic growth. And this has historically been very, very good for equities. And we've seen that in the markets. The markets have broadened out, and we've seen participation from sectors that had lagged far behind the leaders in the technology space. The second is that the quantitative signals continue to be positive. Researchers that I follow that study patterns in price and volume in the market and how that correlates to future returns all provide positive signals. The third is that from a sentiment perspective, as far as we can assess, investors are still a long way from the type of euphoria or greed type of emotion that usually dominates market tops. And a recent example I would use would come from Fundstrat, where they attended a conference in Huntington Beach for chief investment officers, or CIOs. Now, what they found that on the panel discussions, as well as in individual interviews with CIOs, they found a very broad skepticism of the market rally and a belief that there has to be a significant pullback before the market can even attempt to think about hitting new highs. Now, we all understand that human emotion gets in the way of good investment decisions, and that often very, very negative sentiment is a precursor to very, very strong positive returns. We have to remember the old John Templeton saying, and I know I keep repeating this in every video, but I always want to emphasize the fact is that John Templeton, who was a legendary investor, made the amazing observation, that bull markets are born on pessimism, they grow on skepticism, they mature in optimism, and they die in euphoria. And I think it's safe to say that if hundreds of chief investment officers are still believing that the market, they're still skeptical of the market rally, that we're nowhere near the end of this. Very closely related to the question around what happened in September and has it changed anything, is a series of questions I had around what happens to the market typically when the Federal Reserve starts to cut interest rates. Now, I want to be very clear in this situation. There's a very binary outcome, right? If the Federal Reserve cuts rates in front of a recession, the implication for the market is very negative. There's no ifs, ands, or buts about it. On the other hand, if the Federal Reserve cuts interest rates in an environment where the economy is growing, then typically that has very positive implications for the market. So I think it's very important in this situation, if you see a post or you're reading an article, is to understand what data is being looked at. Are they using averages, or are they trying to look at specific circumstances that overlap with current conditions? Because as we discussed before, current conditions bear no resemblance to pre-recessionary environments in many regards. In fact, if you look at the Atlanta Fed GDP Now indicator, it would indicate that the US economy is growing something like 2.9% on an annualized basis. Not as fast as it has been growing in past quarters, but still pretty good. So in this situation, my answer is going to say context is everything, and in the current context, a Federal Reserve rate cut looks like a positive signal for the market. Another question I encountered frequently over the course of my client conversations in September revolved around what's going on with Bitcoin. I think the answer here is very simple. We've had a couple of factors come together that's caused Bitcoin to trade in a range-bound fashion after the large run it had in late 2023, early 2024. Those factors are very straightforward. The first off is just straight up seasonality. Historically, Bitcoin has accumulated most of its positive returns between October and May. And since we've left that time period, it's traded range-bound. The second is that we've seen several large sellers of Bitcoin, including the German government, the US government, and the settlement for the bankrupt crypto exchange Mt. Gox. Now, with large sellers entering the market into a relatively illiquid asset, one would expect a lot more price volatility than we've in fact seen. So I put that as a positive fact. The other thing that's important to remember is that we are still within the halving window, which is the 5 months before and the 21 months after the code in Bitcoin reduces the supply of Bitcoin by 50%. Now, typically, again, in a 4-year cycle, most of the positive returns in Bitcoin happen in this window. But that doesn't mean that they happen all at once or they happen steadily. It tends to be very streaky, and this is why to own Bitcoin, you need to have enough risk tolerance to tolerate 20 to 30% moves around an average. The final question I'm going to touch on in this month's video relates to the future path of interest rates. I think it's pretty clear at this point that when you're in an environment where inflation is moderating and you have continued economic growth, that this gives a lot of room for central banks to cut interest rates. And in the words of several Fed speakers, interest rates are hundreds of basis points too high. So I think the rate path here is pretty clear. Now, we also want to think about how does this affect us as Canadians versus the US dollar in terms of our currency. Now, this is very, very difficult to predict, but I think, in fact, if the Bank of Canada and the Federal Reserve are both on the same rate cut path, that really the status quo is going to prevail. We're going to be trading between 72 cents and 78 cents as long as no other factors come into play. So wrapping things up here for the Kluge Wealth Advisory Group September monthly video, we covered off some back to the basics, touching on the taxation of investments. We reviewed where the portfolio is, as well as what the market did in September. And then we touched on some frequently asked questions. Now, if you have any questions or there's anything you would like to talk about in more detail on a personal level, please reach out and give us a call. We're here to get the job done. And as always, you can find all our content on our YouTube and X channels. Thank you very much for joining me, and we'll look forward to speaking with you all soon.